Warren Buffett famously said that there are three things that can bring someone down in business, and that is ladies, liquor, and leverage, but really just leverage. And that is the private lending industry's number one problem.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here. We're going to dive into this subject. It's quite a problem in the lending industry for lenders, for the people who invest in loans, and even for borrowers, to be honest. And we're talking about over leverage, doing too high LTVs and LTCs on a given piece of property. And to be honest, this comes and goes in lending. Like there are times during a good real estate market and also when interest rates are low that lenders and finance people in general, like the people who put the money together for this kind of stuff, start competing on leverage and on price, and they just want to crank it up as much as they can until something changes, until there's a market correction, some kind of collapse of the financial system. Like we're going to go into a lot of specifics on this, not just like the conceptual things that I started with, but it's a major problem, honestly. And it's something that we fight against every day. And yeah, it comes in a number of angles, and we're going to break them down.
Yeah, I mean, I think it started maybe about a decade or so ago when a lot of institutional capital kind of jumped into the space. I remember when we started, not that people weren't price sensitive, go back 2007 and beyond that. It wasn't that real estate investors weren't price sensitive, and it's not like they didn't want to put a lot of money down, but like things change in different markets and different environments. This day and age, you could buy a crappy deal or overpay for a deal and still get high leverage on that deal, right? If you're in a low real estate market and there's really bottom basement under market value properties, there's an argument of, why not give higher leverage based on your purchase price on an asset like that, right? Because, I remember you could buy a property for $100,000 that was worth 150 or 130 or 140, 150 grand immediately. So given higher leverage on an asset like that is definitely better. It's not ideal, right? You want the borrower to have skin in the deal, right? We're lenders. We're supposed to have the least amount of risk in the deal. And if we're given 100% leverage, we have more risk than anybody in that case. If you're funding the whole deal, if you're going to fund the whole deal, you give high leverage, you might as well be a freaking partner on the deal and win on the upside as well. So that's not the game. But not only is it not good for you as the lender to give high leverage, it's just not good for the real estate investor either. Because one sign of the real estate investor having challenges, they're going to walk on the deal, right? Because it's easy to walk on sweat equity or potential sweat equity, but it's not easy to walk when you have real hard-earned cash into the deal. If a borrower is bringing 30% into a project and the borrower and the deal completely falls apart, the contractor, steals from them, they go over budget, they can't sell at the price that they want. They might have realized that they're not going to profit on this deal. So they're not trying to fight for every sweat equity dollar, but they are going to fight to get their initial capital contribution back. So that's the important part. But again, it's not just good for you to have low levered loans. It's also good for the borrower as well, right? Because you're enabling them or putting them into a spot with very, very little equity that potentially, they could crash and burn on. You're putting them into a bad spot. And I remember hearing about this and it come into perspective in Sam Zell's book when he was talking about how, institutional capital and Wall Street capital are actually hurting. They were obviously fluctuating and making the real estate market so hot because capital is cheap, capital is easy. The barrier to entry to get capital is easy. So if anybody can get a loan, why not? I got no risk. The bank's going to give me 100% financing at cheap terms. So it's not helping these investors either. We're going to elaborate on that.
Yeah, let's talk about some specifics here. Like a couple things I want to go through. Like one, with proper down payments, let's say a real estate investor, residential fix and flip investor here in the DC area has the cash in his market to do, say, 4 deals at once. Okay. With the proper, 20% plus down payment, all the normal real estate underwriting guidelines. And then an institutional lender or even a private lender doing crazy high leverage. We'll talk about those two soon. But say some lender comes along and they're like, oh, you only have to put 5% down, right? And like plus closing costs or something like that, which is real, which is actually happening out there. We see people talking about the terms of the deals that they close on LinkedIn and stuff and Facebook every day. And it's like, who's responsible for this stuff? Who's responsible for these losses? But going back to that one real estate investor, like they say they had the cash to do 4 deals at once. That's what their business has been like. And it's been going pretty well. They make money. Great. Awesome. Good client to have. But if you provide the high leverage financing, you could enable them to get into 12 deals at once. And just because they were a good operator at 4 deals at a time does not mean that they're going to be running the same profitable operation at 12. There's just a very, very high likelihood that they're going to start taking losses, mismanage deals, run short on cash. We've seen it happen many times over the years with residential real estate investors, frankly. I'm sure it happens with commercial too. Like we see very specific deals where in DC, for example, where lenders over the past handful of years have been pretty aggressive. That's starting to change now. But anyway, they get into a large renovation project or maybe a condo conversion, which was hot for a number of years. And it requires a lot of cash to be able to execute well on those. Monthly payments are large. You might go over budget. You might go over time frame. You might have permitting issues. All kinds of stuff can happen when you're speculating on real estate like that. And we'll get calls from people. Jason gets these calls probably weekly where a borrower is like, yeah, man, kind of upside down. The lender's defaulting me. The property I think is only worth, maybe $600K as is because it's incomplete and I owe $700. And it's like, we see it all the time, literally all the time. And we're like, man, we could give you 400, but then that would require you to bring 300. And if you had the 300, you would just complete the job that you're working on. So yeah, it's problematic. It's problematic for the borrower. The lender's stuck. Whoever's investing in these loans, they're in a tough situation. And it's really just silly. It's silly, undisciplined lending because people want to compete and make money. Everyone wants to make money, right? So they start doing risky stuff that's going to end up being worse for everybody. And we talk about this subject all the time. And definitely we talk about this within our mastermind group. We're going to have a meeting with the mastermind group in Atlanta this week. We'll do a recap after we're back from that. But I know damn well that lenders in the group are going to be talking about how they have to compete with these 100% financing jokers. Like I was having a conversation with one of the members of the group after he had been going to some meetup groups that he hadn't been to before. He's trying to drum up some more business, right? And he talks to real estate investors and they're like, yeah, I hear you on your 20% down payment, but like this guy over there, he gives me 100. And then the other guy, he's not here tonight. He gives me 100% too. And I'm like, the only thing that I was talking to him and I was like, the only thing that you can really do, and don't tell the borrower this because it would sound too like aggressive, but like, you just got to wait for lenders who are doing that silly type of stuff to lose money. And they're either going to be out of the game or they're going to adjust to responsible LTVs. There's not much else we can do. Like we can win on other things. We can win on speed. We can win on customer service. If you want, you can win on pricing, but like, we don't really like doing this stuff cheap. But yeah, it's a constant struggle that I know is going to come up this week at the mastermind meeting is that it's hard to compete against this stuff, especially when you're talking about the fix and flip.
Yeah, no doubt. And I mean, I'll tell you, I feel like our team has some pretty good scripting around that. Because you have to, and you got to build a relationship with the borrower and say, hey, listen, I get it. You need $40,000, $50,000 cash to close on my deal. You need $70,000 cash to close on my deal. You need 40 or 50,000 on this other lender's deals. I get it. It's less cash. It's less cash to close, and maybe they're a better option for you. And you can leverage your relationship. You can leverage, you being local, fast, easy to work with, quick to work with. Like people aren't going to necessarily, you're not going to lose a deal necessarily over a half a point or a point or a few $1,000s, but you will lose it over $30,000 difference in cash to close. right? Like if they can get a higher level, but the important part is stay in front of them, building that relationship with them at some point, because I've seen it 100 times. They'll come back and be like, you're right. That lender wasn't easy to work with. Because guess what happens? Here's another tip. If you are going to do 100% financing and that lender at the RIA is going to do 100% financing to this person, they are micromanaging the hell out of that project because they have to. That borrower has to be precise on their construction budgets. That loan has to perform perfectly, and the borrower has to perform perfectly in their renovation process and their whole buying process, or the buyer is going to lose money and the lender is 100% going to lose money on that deal. It has to be done perfectly, and because of that, they're going to get micromanaged. And I'll tell borrowers this on the phone and say, hey, listen, I understand you need to bring a little bit more money cash to close than ideal. That being said, I'm not going to babysit you, and you don't want me to babysit you. And you don't want us to, I don't want to babysit you. You don't want us to babysit you, because I'm going to give you leeway on this deal. If you do, $8,000 worth of work on the property, you do a roof, you do some framing, and you say, I did a good bit of work. I need 10,000, and it ends up being like 8,000. Like, I'm not going to nickel and dime you over $1,000 draw here and there. That lender that's given 100% leverage, they have to nickel and dime you, right? Because they have to be super precise, because if this project doesn't get executed perfectly, they're losing money, right? We're not babysitting our borrowers, and we tell them that, and they appreciate that. And a lot of them come back to us and they'll be like, you know what? This guy does offer 100% financing, but he's a pain in the neck to work with. He's always making, this particular person sign, and he's got this paperwork, and he's hard to work with this. I can't ever get draws from him. I have to use his title company, right? And he has to. Like, I don't blame that person. If they're going to give 100% leverage, you got to control the whole freaking transaction, because nothing can go wrong, right? I mean, nothing. It's got to be perfect. So that's something you can sell against. And if you don't get the deal, that's okay. Potentially you can get the next opportunity that comes in there. But it's fine. And, a thing that I kind of always think about, and, I interview a lot of successful real estate developers and investors on our other podcast that we do for our Hard Money Bankers audience, Real Estate Reserve podcast. And the consensus has been for a lot of the older investors, and I like this because I think about this all the time, is high leverage is good for growth, but it's also very risky, right? So if you're a real estate investor and you're like, I need to do 20 deals this year and I don't have a ton of money, they have to have high leverage. They got to get high leverage from their lenders and keep going through deals over and over and over and over and over, because they're trying to make tons of profits. And I get that. And that's fine. If you're in the growth stage, maybe you want high leverage, because that's the ability to do more deals. But there's a lot of risk that comes in. And then you become a little bit more mature and you're like, you know what? I want to take a little bit less leverage because I want to prevent some risk. I want to have equity. I mean, as a real estate investor, you don't want to have 100% leverage on a deal and have zero equity or very little equity on a deal. That doesn't make a lot of sense. If anything goes wrong, you're going to lose money on it, right? So sometimes you got to think about the real estate investor side, not just your side, because that can help you communicate and work with them on them. Like, hey, listen, I get these guys are giving 100% financing, but these are your risks for even taking 100% financing on the deal if something goes wrong. And then what I've learned from a lot of successful real estate developers is, as they are developed and matured and older, they want like no leverage on their deals. They don't even want financing, or they want very, very little financing. I'll tell you, there's borrowers that come to us every day. We do loans like this all the time. And you might be thinking like, oh, I don't get those deals like that. Well, you would if you scripted the right way and communicated with them. They'll come to us and be like, hey, what types of terms are you looking for? How are your deals structured? And I'll have a conversation with them and say, I'll go through our process. I'll build credibility. I'll ask them what type of loan amount that they want. And a lot of the times they'll say they want higher leverage than they really even do want. And I'll come to it and be like, hey, listen, if we give you a loan of like, 100, can you put up 100? You're buying it for 200. If we put up half, you put half. Be like, yeah, that's not bad. I have that availability right now anyways, and I don't have another deal, and I'd rather not have to pay the fees and the points and the high leverage anyways. So I'll take it. Like, that happens a lot. Mature real estate developers, investors don't want the highest leverage. Like, you got to think about that as well. Like, that's important. And then let's be honest. If they put up 100, you put up 100, you're a very safe deal, but they're also a safe deal. They have a lot of wiggle room on that. So it's not all about highest leverage, highest leverage, highest leverage. I know that the industry has kind of made it seem like that's like that, but it's not.
Yeah, I mean, and borrowers, real estate investors, and brokers are all kind of trained to call a lender and ask for the highest loan amount they can get. It doesn't really mean they need it or want it or that it's a good idea, but like everyone thinks, just like if you call a conventional lender, you're like, oh, what's your rate? And they do that with private lending too, with investment property lending. And then the next question, if not the first question, is what's the max you can lend on this? And it doesn't have to be that way. I'm glad you brought up scripting. Scripting's important. And I just don't understand how, because when you're talking about social media and what people put out publicly and the good stuff that they're talking about their company, it's always the positive. It's always like, hey, we closed this deal, right? Or hey, we put out X amount of loan volume in September, right? But nobody talks about the problems. We try to talk about some of the hairy situations on this podcast that happen inside of a lending company because we want to give our audience of private lenders the real deal of what happens. And I just don't understand how some lenders are still in business when they're just bragging about how they do 100% financing. Like if you've been lending for any length of time, you've managed defaults, you probably had foreclosures, and you know what those numbers look like. They're typically always on a property that's incomplete, and an incomplete property with an as-is value gets pretty damn tight. If you're doing 100% loan to cost, you're just losing your shirt whenever you get a default, and it shouldn't be that way. As a first mortgage lender, we should not lose principal even in a gnarly default. Now, you might not get all of your interest and everything else, and like, so be it. But it's the system, the underwriting is designed to protect your capital. That's the way it's always been. It's the way it's supposed to be. And I remember listening to a podcast earlier this year. There was a nationwide or regional lender on there. He was going through like his company's history, and they built a big business. They do lots of loan volume in a number of states. And he was talking about how he was selling loans that were funded by his fund and then to the secondary market. And he's like, yeah, so, I'm talking to these Wall Street note buyers and, they're trying to offer me 90 loan to cost, 95 loan to cost, but I need 100 loan to cost. And I'm like, why do you need 100 loan to cost? How are you still in business? I don't get it. And who knows, like maybe it's built into their capital model, loan loss reserves, like a bank that you're planning on losing X percent of principal. I don't think most lenders are like that. I think banks are like that because they have to be, because they're regulated to have a certain amount of loan loss reserves. And then there's a whole issue of like institutional money and buybacks, and like that's another can of worms. But I just wanted to keep this topic to the number one, without all the downstream effects and everything else, just the number one problem in private lending, which is over leverage.
Yep. That's all I got for today as well. I think this is an important topic, and lenders that have been in business for less than a few years, I don't think have fully cycled through this to see. I mean, we've learned that real defaults on your books they take time, even if they're short-term loans, before they're realized. It could take 3 years for that to happen. So just be cautious and work on. And I get it. If you're working with the same borrowers over and over, you're giving them high leverage and cheaper fees. You don't want to disappoint them. I get it. It's hard to take a step forward, even though you could potentially go 2-3 steps forward. After that, it's hard to take a step backwards to go a few steps forward, but it's important. And you're going to learn it the easy way. You're going to learn it the hard way. And the hard way is, you have a book of business with high leverage, and your borrowers that are used to doing that, and you're not out there marketing for new borrowers to put higher down payments down. And you have a few borrowers that default, and, they default on one of your loans, and then the rest of your portfolio that you're doing loans for go with it as well. I mean, we've been involved with lots of deals where, we've lent. I mean, we had a borrower that we made them put down 20% on every deal, and we had several loans going in at once with them, and one of them was a gigantic headache loss for him, and that crippled him. And the rest of the deals, he's like, I know I put a lot of money into this thing, but like I need to walk away from these things because I can't keep them afloat. And that was with money down. So just be careful if you're not getting high down payments.
That's the pod for today, guys. Keep fighting the good fight and maintain proper real estate and lending fundamentals. If you haven't done so already, come check us out at hardmoneymastermind.com, and we'll see you here next time on the podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.